Hi everyone, welcome back to another video in our channel. For those of you who don't know me, my name is Matapelo Mapangela, and yeah, welcome to everyone. To all the new subscribers, we see you. Shout out to you. To all the returning subscribers, thank you for the love, thank you for the comments, thank you for the suggestions. We genuinely do appreciate it. Yeah, welcome. So today we are doing yet another financial literacy video, and today we are talking about something that has made the news recently, right? Which is fixed interest rate versus variable interest rate. So the reason why I wanted to do this video is, so after the governor of the South African Reserve Bank announced the cut on the repo rate, there was a lot of excitement, right, on social media, and understandably so. And I found myself being amongst those who were excited, because you know why? I thought that the cut in the repo rate means a cut in the prime rate, which ultimately means that everyone who has debt will ultimately benefit. But little did I know that that is not the case, right? So there is some truth in the statement that I have made, but there is also what is not true. So I just want to clarify it in this video. So yeah, I hope that you'll find this video very informative and very fruitful, so that you can be able to apply it in your day-to-day life. So getting into the video, so maybe let's start like I usually do. I like to unpack or understand the definition of whatever it is that we are doing. So today, when I started my sentence was that when the governor of the South African Reserve Bank announced a cut on the repo rate, there was a lot of excitement. People felt as though they are going to benefit. Everyone felt as though it will be beneficial for them as borrowers, which is not the case. So what is a repo rate? A repo rate is the rate at which the South African Reserve Bank borrows or lends money to commercial banks, right? Commercial banks, it will be your likes of Capitec, your likes of Standard Bank, your likes of Nedbank, and etc. And then what commercial banks do is to charge us meaning me and you, borrowers, is to charge their borrowers what they call a prime rate. So a prime rate is the rate at which commercial banks charges to consumers for lending them money, right? So a cut on the repo rate means ultimately results in the cut on the prime rate. So when the Reserve Bank reduces the cost of borrowing for commercial banks also reduces the cost of borrowing for their consumers, which is you and I. But there is a catch to this. So whether you will benefit when the repo rate is cut, if you are a borrower who already has an existing debt, depends on whether your debt is on a fixed interest rate or on a variable interest rate. So I will clarify what it means. What do I mean by fixed interest rate, and what do I mean by variable interest rate, and what are the pros and cons of each? So I want us to really have these conversations, so that in the near future or next time when you go and take debt, you know you are informed, you make a decision that is informed. In my previous video, I spoke about secured versus unsecured loans, and today I deliberately want to talk about fixed versus variable interest rate, because these are some of the things that financial institutions don't really tell you, because for whatever reasons, maybe they might think it's common knowledge, but not all financial institutions make this to their borrowers known, that when you undertake a loan, you actually have an option to choose between a variable interest rate and a fixed interest rate. Some of us, when we just apply for debt, as soon as it is approved, we don't even negotiate the interest rate, we don't even negotiate the type of interest rate that is charged on the debt. And that is really what my aim is. I'm trying really to educate that you have an option to choose between the type of interest rate that you are going to pay on your debt. So like I said, there are two types of interest rate. You have your variable interest rate, and then you have your fixed interest rate. So let's start with the fixed interest rate. So with the fixed interest rate, what it means, it's simply that it's fixed. So you will pay the same so your repayments will be the same over the long your loan term. So your repayment will be the same over your period of your loan. For instance, if you have borrowed 20,000 over 5 years at the interest rate of 9%, and you will be paying 10,000, and you will be paying 2,000, you will be paying that 2,000 will be constant over your loan term, right? So I think that is what we mean by a fixed interest rate loan. And the advantage of taking a fixed interest rate, it means that there's certainty. You know exactly how much you will be paying over your loan period. So it makes it easier for you to even budget for other things, or for you to even budget to add maybe an extra 200 rands, to add an extra 500 rands, and so forth, right? And that is the advantage. And then the disadvantage of undertaking a loan on a fixed interest rate basis is that, like what happened recently with the cut on the repo rate, when you have existing debt and the repo rate is cut, which ultimately means the prime rate is cut, you don't benefit from it because your interest rate is fixed. So whatever happens, even if the repo rate can be cut to 1%, you don't benefit from the cut because your interest rate is fixed. So if the repo rate is cut to 1%, you don't benefit from that because your interest rate on your loan is fixed. And the other disadvantage is this, and I really hope that you can bear with me. I want to make this as practical as possible. From a bank's perspective, from a financial institution perspective, remember they also need to make profit, right? So when your interest rate is fixed, what they do is they want to be in the middle as possible. So in the middle, so they want to be on the beneficial side as much as they possibly can be. So what do I mean by this? So what I mean is, so when the repo rate is cut, it benefits the bank, because for the bank it means your interest rate that you will be paying is fixed, right? But when the repo rate is increased, right, it means now you are on the beneficial side, because when the repo rate is increased, the interest rate on your loan will not be affected, because you will be paying the same amount of money over your loan period. So what does the bank do? Research shows that the interest rate on a fixed interest rate loan are higher compared to the interest rate on a variable interest rate loan, mainly because of that in an event that the repo rate is increased, you who has a debt that is fixed interest rate dominated, you are the one who is likely benefit. So the bank tries to mitigate that risk by charging you a higher interest rate, so that whatever the case may be, they are still in the middle, right? So they are still in the middle, but in the middle in a sense that, so when the repo rate is increased, they will be the one that is likely to lose, but when the repo rate is decreased, they are the one that is likely to benefit. But the losses that they want to incur from that, should the inverse happen, they want to minimize it as much as they possibly can. So what do? The interest rate on a fixed interest rate loan is slightly higher. So those are the disadvantages of a fixed interest rate loan. So getting into your variable interest rate loan. So a variable, it simply means exactly that. It is variable. It fluctuates, right? It depends on what happens in the market. So people who have loans on a variable interest rate, when the repo rate was cut, their interest rate that they are liable for paying was also reduced, because when the repo rate is cut, the prime rate is cut, which is the cost of borrowing. So it means even their interest rate will be reduced, right? And when the inverse happens, the inverse is true. So the inverse is also true. So when the repo rate is increased, the prime rate is increased, and as a result, the interest rate that they are liable for paying will also increase. So that is the difference between a variable and a fixed interest rate. Variable, it fluctuates depending on what happens in the market, and then with a fixed interest rate, it stays constant, so it is not affected by what happens in the market. So the advantages of taking a variable interest rate is that, just like what happens when the repo rate is cut, you are likely to benefit, because even the interest rate that you are liable for paying will be reduced, right? And then that is the biggest advantage of it. And the other advantage, like we said, with a fixed interest rate, the bank normally charges a higher interest rate, whereas with a variable interest rate, the interest rate that is charged on a variable interest rate loan are slightly lesser compared to a fixed interest rate, right? And then coming to the disadvantages, the disadvantage is that in an event that the repo rate is increased, and so in an event that the repo rate is increased, it means even the interest rate that you are liable for paying will also be increased, and this won't be as beneficial, especially if your financial muscle cannot stretch that much, especially if your financial muscle is overly stretched, if your finances are constrained, if you know that after paying all your discretionary and your non-discretionary expenses, you are not left with a lot of money. So in an event that the repo rate is increased, you might be unable to honor your debt obligations, mainly because of that unforeseen event. And then the other disadvantage is it's uncertainty. There is a lot of uncertainty. If you are someone who does not like a risk, if you are someone who does not like taking risk, maybe the fixed interest rate will be beneficial for you. But yeah, there is a lot of uncertainty as far as a variable interest rate is concerned, because you don't know what might happen tomorrow. The governor, obviously by monitoring what is happening in the economy, that you can really predict some of these things, but you never know how much, at what percentage points will the repo rate be increased, or at what percentage points will the repo rate be decreased. So there is a lot of uncertainty around it, and for me that is the biggest disadvantage. So the reason why, so to answer the question that I started with, the reason why not everyone benefited from the cut in the repo rate, it mainly depends on the interest rate that their debt is in. So if your debt is in a fixed interest rate, you did not benefit. If your debt is in a variable interest rate, you benefited. So it is very important to learn more about the pros and cons of each, especially if you are about to go into the space of borrowing, so that whatever decision you make is informed. So yeah guys, that is my 2 cents on variable versus interest rate versus fixed interest rate. I hope you enjoy it. Let me know in the comment section below if you would like me to do more financial literacy videos. Yeah, I hope you really do enjoy it. Don't forget to like this video if you really enjoyed it. Don't forget to comment in the section below. I really love engaging with you guys. I really love hearing new perspectives, but more than anything, don't forget to subscribe. It means a lot to us. Until we meet again, I love you guys so much. May God bless you, and bye.